Understanding credit. Building a strong credit foundation for personal and career growth. Introduction. Credit is one of the most powerful financial tools available to young people. It allows you to access money, invest in opportunities, and build a financial reputation. However, if misunderstood or mismanaged, credit can lead to debt, stress, and financial setbacks. For young people aged 18 to 35 who aim to start a career and lead financial literacy in schools, understanding credit is essential because it affects your ability to borrow for education, business, or personal growth. It influences your long-term financial stability. It equips you to guide students on responsible borrowing and financial planning. This module will cover what credit is and how it works, credit scores and reports, how to build and maintain good credit, practical exercises and school applications to teach others. By the end of this module, you will have the knowledge to manage your own credit wisely and teach students how to do the same. Section 1. What is credit? 1.1 Definition of credit. Credit is the ability to borrow money or access goods and services with a promise to pay back later. When you use credit, you are essentially being trusted by a lender to repay funds in the future. Examples of credit: bank loans and personal loans, credit card balances, microfinance loans, student loans or educational financing. 1.2 How credit works. Credit involves three main components: principal, the amount borrowed; interest, the cost of borrowing money, usually expressed as a percentage; repayment period, the time frame within which the debt must be repaid. Example: if you borrow $1,000 at 10% annual interest for 1 year, you will repay $1,100 by the end of the year. Section 2. Credit scores and reports. A credit score is a numerical representation of your creditworthiness, how likely you are to repay borrowed money. Lenders use this score to decide whether to lend to you and at what interest rate. 2.1 Components of a credit score. Payment history, 35%, paying bills and loans on time is the most critical factor. Amounts owed, 30%, the total debt you carry relative to your credit limits. Length of credit history, 15%, how long you've been using credit responsibly. Credit mix, 10%, a combination of credit types, credit cards, loans, mortgages. New credit, 10%, recent credit inquiries or new accounts opened. 2.2 Understanding your credit report. A credit report contains personal information, name, address, credit accounts, type, limit, balance, payment history, public records, bankruptcies, court judgments, inquiries from lenders. Regularly checking your credit report helps you detect errors or fraudulent activity. Monitor your progress in building good credit. Make informed financial decisions. 2.3 Global credit reporting systems. Different countries have credit bureaus that provide credit information. Examples include USA, Experian, Equifax, TransUnion. UK, Experian, Equifax, Call Credit. Nigeria, CRC Credit Bureau, First Central Credit Bureau. India, CIBIL, Equifax India. Tip for young people: know your local credit reporting system and check your report at least once a year. Section 3. Benefits of good credit. Maintaining good credit provides numerous advantages. Access to loans and credit cards. Good credit increases your chances of approval for student loans, mortgages, and business financing. Lower interest rates. Lenders trust borrowers with good credit and offer lower rates. Better renting opportunities. Landlords often check credit history before leasing property. Employment opportunities. Some employers check credit history for financial roles. Financial security. Good credit allows for better planning and fewer financial emergencies. Section 4. Risks of poor credit. Poor credit can have long-term negative consequences. High interest rates. Borrowers with poor credit pay more to lenders. Loan denials. You may be refused loans, credit cards, or mortgages. Limited opportunities. poor credit can affect jobs, rentals, and even insurance premiums. Stress and financial strain. Mismanaged credit can lead to a cycle of debt. Section 5. How to build good credit. 5.1 Start early. The earlier you start using credit responsibly, the better your credit history will be. Young people can start with small credit cards, microloans for educational or entrepreneurial purposes, student loans with manageable repayment schedules. 5.2 Pay on time. Always make at least the minimum payment by the due date. Late payments negatively impact your credit score. 5.3 Borrow within your means. Only take loans you can repay. Avoid maxing out credit limits. 5.4 Diversify credit types. Having a mix of credit types, credit card, personal loan, student loan, shows you can manage multiple forms of credit responsibly. 5.5 Monitor credit regularly. Check credit reports for accuracy. Dispute any errors immediately. Use apps or bank tools to track credit activity. Section 6. How to maintain good credit. Maintaining credit requires discipline and ongoing management. Set payment reminders, use phone alarms or apps. Keep credit utilization low, aim to use less than 30% of your available credit. Avoid unnecessary credit inquiries, each inquiry can slightly reduce your credit score. Pay down debt consistently, reduce balances instead of only making minimum payments. Plan for emergencies, maintain an emergency fund to avoid borrowing unnecessarily. Section 7. Credit for young entrepreneurs. For young people aiming to start businesses, credit is a critical tool. Business loans fund startups and cover operational costs. Lines of credit access flexible funds for short-term needs. Credit cards manage cash flow for inventory, marketing, and supplies. Tips for entrepreneurs. Only borrow what is necessary. Keep personal and business finances separate. Monitor repayment schedules carefully to avoid late fees. Section 8. Teaching credit management to students. As a Coffee Hub leader, teaching credit literacy in schools is crucial. Interactive role-playing, simulate borrowing, repayment, and credit scoring. Visual tools, use charts to show how debt and repayments affect credit scores. Case studies, share real-life stories of good and bad credit management. Group activities, create mock banking and credit clubs where students practice applying for credit and tracking repayments. Needs versus wants, reinforce borrowing for value creation, not consumption. Section 9. Common credit mistakes to avoid. Missing payments, late or skipped payments harm your credit score. Borrowing excessively, taking on more debt than you can repay leads to financial stress. Relying on payday loans, high-interest short-term loans are dangerous. Closing old accounts. Closing accounts too early can reduce credit history length. Ignoring credit reports, errors go uncorrected, and fraud goes unnoticed. Key takeaways for young people. Credit is a tool, not free money. Borrow wisely and repay responsibly. Start building credit early. Small, responsible use grows a strong financial reputation. Monitor and manage your credit, regularly check reports and stay disciplined. Separate good and bad credit, borrow for growth, not consumption. Teach others, use coffee clubs to instill credit awareness in students. Good credit opens doors to education, business, housing, and career opportunities. For young people globally, mastering credit literacy is a step toward financial independence and empowerment. Conclusion. Understanding credit is fundamental for young people who aspire to financial independence, entrepreneurship, and leadership in schools. Credit, when used wisely, enables growth and opportunities. Mismanaged, it can cause stress and financial setbacks. By mastering credit, young people can secure loans for education and business, maintain financial stability, build a strong foundation to teach financial literacy in schools. Coffee Hub leaders can use this knowledge to educate students, helping them build responsible credit habits early, creating a generation of financially empowered individuals.